thoughts on MapmyIndia, because we have the management joining us. Now, just for the benefit of our viewers, right, this is a company that listed in December of 2021. It listed at about 1581 rupees and it went all the way to 1900. But since then, since the listing price, the stock is now down almost 15% at about 1350 or so. The revenues this quarter came in at an all-time high. The company's G Trophy business looks solid with the revenues doubling on a sequential basis. But it's the margins where we have seen a contraction this time to 41% versus 47% last year. Rohan Verma, the CEO and Executive Director at MapmyIndia, joins us now to talk about that. Rohan, that seems to be the problem, right, on the operational front. And I guess that's what's reflecting in the stock as well. Your margins now 41%, profits have not grown compared to same time last year. Do you anticipate more operational pressure? And what could the triggers be for the second half of the year?
Good morning, Sonia. Thanks for having me on your show. Actually, if you look at our business, it's in a very good situation. Revenues have been growing 35%. This G2P business has, doubled its revenue sequentially. Now, there are some dynamics at play, which we kind of explained even last quarter. We are making basically three investments. One is in scaling up the G2P business, which is an IoT device-led business. In this, your initially a margin when the device is sold is lower, but then you start getting the higher SaaS margin, subscription margin in the subsequent years. So as that business grows, there'll be an impact on the margin, but the overall absolute contribution will start growing. The other two investments that we are doing is in the brand building and awareness for MapmyIndia and Mappls, because one of the things that will drive future growth for the company is more and more people knowing about MapmyIndia and Mappls, both the platform, which is for B2B and B2B2C, but also the consumer side. And lastly, we are kicking off a lot of investments in the new product development, which is keeping us ahead of any new competition, whether it's in drones, whether it's in real view 360-degree or metaverse maps, or even our software for digital transformation or our NK suite and our APIs. So we basically are able to keep our EBITDAs and PAT in a particular range where we feel comfortable. We've talked about 35 to 45% EBITDA and 30 to 35% PAT. So what you are seeing on a year-to-date basis is actually pretty healthy.
So
Rohan, that still doesn't answer Sonia's question. You know, your revenues are growing very well, 41% for the half year. But that's not reflecting at the EBITDA profit level. That is growing slower than the revenue. So the worry about margins persists.
Lata, again, I'll repeat it. When the G2P IoT business grows fast, your initial margins will be under pressure. Yeah. But the subsequent year margins will come up. Coupled with investments in marketing and product development, this will affect EBITDA margin. But if you look at it, 60 crore EBITDA in the first half, 50 crore PAT in the first half on a base of 140 crore revenue, which is 40% up on a year-on-year basis for first half. We're pretty happy with where we are.
Yes, you've given us a margin band, but can you just tell us these investments that you're making, right, in marketing, in product development, in Mappls brand building? What is the average investment this quarter, in the quarter to come, compared to, say, what it was about 2 quarters ago? And what is the kind of expenses that you're sort of allocating which could impact your margins in the second half?
Correct. So if you look at our expenses in this quarter, and we've broken it up to show kind of what the difference is between marketing and other expenses, etc., you'll see an upwards of 5 crore, 3-4 crore change in the marketing expenses on a quarter basis. That is one. And on the PAT side, at least I can say that the other income and the effective other income is lower compared to the previous year, same time, and effective tax rate is higher. So that's the dynamics playing with PAT, at least in this quarter.
Okay, all right. Hi, Rohan. I was looking at your organic growth actually. Though the headline number looks very good, the organic growth, it appears it's around 18 to 19%. So that's a little bit slower. But be that as it may, what do you end this year with in terms of a revenue number, point number one? And also give us a number. What is your open order book as of the half-year mark?
Nigel, important thing to understand is the IoT business that MapmyIndia had before.
Yes.
plus adding Gtropy as a acquisition at end of this past year, so just 6 months or so ago, we've combined the two IoT revenues. So apple to apple, actually, the organic growth is actually slightly higher than what you said. We don't give specific guidance for revenue on a forward basis, and also the open order book is something that we talk about on an annual basis, because order books are lumpy. But you should be able to get a particular trajectory by looking at a half-year performance. And I can also say on the order wins, qualitatively and quantitatively, the momentum is looking quite strong with order wins across the segment.
Rohan, so second half of the year will be as good as the first half?
That's what we are gunning for sure.
Okay, got it. What
but
about
Rohan, what is the opportunity size of this Gtropy and other products that you're launching? Are you the only one in the field? And by when will the revenues start looking, the EBITDA start looking better? As you say, this is capex heavy, it's front loaded. But when will it, start paying off? So two questions there.
Yeah, Lata, great question. See, the opportunity size is multi-billion dollars. That's why investing in scale-up is attractive to us. There are 28 crore plus vehicles on the road which can benefit from GPS-based digitization, because logistics efficiency has to be created. You have the Gati Shakti and National Logistics Policy coming in from the Government of India. We are part of the Unified Logistics Interface Platform. So, we are at the heart of what can drive logistics efficiency through technology. And that's where we see this very, very big opportunity. If you just multiply that by a couple thousand rupees, on average of sales revenue, really you're looking at a multi-billion-dollar opportunity. And we are best positioned with the best product, with a unique map, plus the IoT solution to take advantage of this large opportunity for Gtropy.
Okay, one area in which you have made an investment is auto startups. You recently invested in a startup called Navgati as well. Now, these take time, right? There's a lot of cash burn as well in startups. So the concern is that perhaps you'd use a part of your cash. You have about 400 crore cash on your books, and to incubate startups. And that may be another drain for you on your profitability. Any thoughts here? And are you looking at that as one of the avenues of investment as well?
Yeah, see, cash in terms of Q2, we've grown from 390 odd crores in end of Q1 to 430 crores cash and cash equivalents in end of Q2. So I think cash position puts us in a position where we should make some investments which can drive future growth. Navgati is a very small investment, and we have roughly 3% in the company. We have put in 1 crore. It's not a large number from the investment point of view, and the real advantage to that is oil and gas as a vertical. We can go deeper together with them, which is their SaaS vertical SaaS focus. The other investment that we've made is in Kogo, which actually is quite interesting. It opens up a travel commerce market opportunity for us, where they are a gamified social travel commerce platform. Think of Instagram plus for travel, focused on commerce with a community and loyalty angle. This is very interesting to our automotive OEMs who are trying to drive loyalty and consumer engagement through the tech in the car and the companion app, and they're all about travel. Plus, this opens up a consumer opportunity for us in future. Again, that's also very large addressable market. So MapmyIndia is on a very strong foundation in terms of maps and tech. We are trying to open up addressable markets for us in the future that can position us very strongly in the medium term. I think our organic profitability, which is in that 40% EBITDA range, 30% PAT range, is supporting the fact that we should make investments when we see very large technology addressable markets ahead for us.
Got it, Rohan. Unfortunately, out of time. Thank you very much and all the very best.